Growth investing is an investment strategy hell-bent on increasing an investor's capital. Have you ever had a dilemma between growth investing and getting dividend income? Which is better, taking a regular cut or putting it all back? After all, there can be a significant increase in your average returns over the years of the investment journey. This is a video to answer the question, is high dividend income better than growth investing? Today, we explore what dividend income is and how the dividend is a trade-off with growth. Growth investing by definition means maximizing growth, and so we will see how much difference it makes in reinvesting dividends for growth. Finally, we understand the process of deciding which is better for your investment journey. So, hit the like button and let's dive deep into a versus battle of dividend and growth investing. What is growth investing? For growth investors, if the company is in good health and growing at a very fast rate and expected to continue to do so, then that is an ideal investment. Growth investing puts earnings growth and the power of profit margins as the keystones of their investment thesis. This strategy can be better understood by defining growth stocks, which growth investors are looking for. Growth stocks are mostly emerging companies with a shorter track record but a very high rate of growth. Buying prices in such companies does not matter, as the stock is probably a multi-bagger due to the high growth pace. Such companies are small in size, but outpace the industry average by a high margin. Fundamental analysis of such stocks focuses on earnings potential by using metrics like historical earnings growth, net and gross profit margins, returns on equity or ROE, and overall financial health by looking at debt interest numbers. Thus, it is heavily biased towards earnings growth analysis. Growth stocks themselves are highly unlikely to give high dividends. If a company doesn't have good opportunities to invest, they resort to the dividend to return the earnings to investors. But growth companies are on the other end of the spectrum. They quite literally have huge space for growth. In fact, many of these companies avoid paying a dividend altogether, as they believe the higher the earnings reinvested into capex and the expansion the better. Companies like Amazon in the US market and Bajaj Finserv, 3M in India are such growth stocks that don't pay in dividends at all. Thus, growth investing is a journey to hunt such stocks. Ideal picks would grow at a very high rate and do not pay dividends at all. Chapter 2. What is dividend income? The next is the question of what is dividend income. The answer lies in basic fundamental analysis. Dividends are regular cash coupons that a company pays to its investors. Whatever income the company has made in a year, it can only really do two things with it. The income we talk about here is net income. That is, whatever amount is left after addressing all costs, employee remuneration, and other outgoing heads. So, either the company can reinvest the income in the business to expand it further, or the company can return the income to its owners, the shareholders. Capex, like the purchase of new machinery or expanding into a new region with a new branch, etc., are funded either by borrowing by debt or loans, or from the income accumulated as cash and liquid assets. Capital expenditures, or capex, in short, is the way that a company's income will rise in the future. On the other hand, the company can also use the same methods to return some cash to the shareholders. Usually, such dividends are paid by accumulated income only. This is theoretical. In practice, companies do both with different proportions shared between capex and dividends based on their business model. So we already know there is a certain trade-off between dividends and growth on the business side, even before your investment scenario begins. Chapter 3. Why companies declare dividends? But then a question is birthed. Why declare dividends at all? If we know that reinvestment is going to bring in future growth, then why do we remove this quite essential cash from the business? There are several reasons for this. First is that the company simply does not have enough capex to execute. In this situation, the business is very cash rich and generates income, but expansion is difficult or unnecessary. Then such a business has to return the income as dividends to its shareholders. An example of this case is the company ITC. ITC is now an FMCG giant, but it actually generates huge cash profits from its cigarette business. Now, for an already huge FMCG business with a national presence, it is difficult to think of ways to deploy cash into expanding it. Hence, ITC has usually paid high dividends. Its dividend yield is 3.4% even today, after zooming over 50% in the past 1 year. The second reason is the attraction of consistent dividends. There are certain classes of investors that look at a company for regular income. Good businesses will expand, but they also need to pay regular income to some large shareholders who need that. This is true for senior citizens or older investors who look for regular income along with a good stock profile. The attraction of dividends is also based on the consistency of dividends. If a company has paid regular dividends and periodically increased them through the last 10 to 20 years, then that company gets a premium for its consistency and stability. Here, Coca-Cola Company is one such stock with over 50 years of dividend history. The last reason is much less relevant, but seen frequently in the case of public sector undertakings, or PSUs. These are corporations with significant government ownership. Now, as any aware citizen knows, the government is always running a deficit on its budget and needs money to do its work of welfare and infrastructure creation. Thus, governments pressure the PSUs to declare higher dividends as they have a large shareholding in these companies. Also, PSUs have allocated markets with many PSUs sharing the same sector, but operations are limited to a region. So from both ends, a high dividend is a possible result. Here, we can cite many examples. Currently, 3 PSUs, NMDC, REC, and Power Finance Group, have over 10% of dividend yield. If you haven't figured it out already, a 10% dividend yield means you get back all your investment as cash in just 10 years with 100% returns. So, now that we know returns are also possible through dividend income, let's do a versus battle of growth investing versus dividend income. But before that, if you're liking this video so far, drop a like and press the subscribe button for more such content. Chapter 4: The Trade-off Between Growth Investing and Dividend. So, we already understood how dividend takes out cash from the business, and that leaves less go-to around for capex for expanding and growing in the future. But the same logic would answer your question in your investment journey. Consider investing as your occupation or business. Taking out dividends from your investment business will mean less is left for you to invest. If you're not investing the maximum amount, then you may not be having optimum growth. But this is just a logical inference. Let's look at this from a numbers point of view, which will give us an objective scientific answer to how big is the trade-off. Let's take the example of mutual funds as they provide aggregate answers with a good history. Usually, mutual funds have growth and dividend options to go for. Mutual funds also pay regular income in form of dividends if you did not already know that. For our case, let's take the HDFC Top 100 Fund, which is a large cap conservative fund. We take an investment period since inception in 1996, which is about 26 years. We assume a lump sum investment of 1 lakh rupees initially, and then check the difference in return from the growth versus dividend option. The fund value for the growth option is 171,000, which means a total of 71% growth and an 11.44% CAGR return. On the other hand, the dividend option provides a total return of 155,000 when we add total dividends to the current fund value. This is about 55% profit at 9.3% CAGR. You can do a similar analysis for more aggressive growth stocks and funds, but you can conclude that the logical inference was correct, that any way you split it, you will have less value by taking out dividends than if you were to go for maximum growth. So, before we answer the core titular question of what you should do, go down in the comment section and tell us which one do you prefer, investing for dividends or growth. Chapter 5: Which is better for you? The last part of the analysis was to comment on not what is better in terms of end value, but to guide you in deciding which is better for you. In terms of total returns, both logic and calculated numbers say that you're better off with growth investing. But there are a few caveats to this line of thinking. The first is, you do you. You have to think for yourself about what suits you. A young investor in their 20s should go for maximum growth and reinvest all dividends, while an elderly person may need some regular income to support his retired life. The second caveat is taxes. The Indian government has done away with the 10% DDT, or dividend distribution tax, and all individual investors will be taxed as per their tax slabs. Hence, dividend income may yield you lower tax at a lower income. On the other hand, your stock sale will be subject to capital gains tax of 10 to 20% depending on the tax regulations at the time of sale. This may mean that you may have to shell out a greater percentage of tax for reinvesting than you may have paid for taking dividends. So, there are some caveats as per your individual case. In conclusion, we understood why and how companies declare dividends. Dividends can be your partner for growth if reinvested or stand as regular income in your account. Mutual funds too have similar options as per your needs. An objective analysis says that the end return of growth investing gives you a larger return, but we saw some terms and conditions apply asterisk marks to that. In the end, you're able to decide for yourself with the lessons of the video. Please go ahead and press the like and subscribe buttons for more such content. Don't forget to express your preference, dividend or growth, in the comment section. If you enjoyed this video and got our point that a small step of reinvesting dividends can lead to a big change in the end result of investments, you will like this video on how to make 1 crore with 1000 rupees per month SIP.